Hello, and welcome to the Wade Borth Podcast. I'm your host, Wade Borth, and in every episode, my goal is to get you to think differently about how money works and ultimately to empower you to take control of your money and your personal financing system. Hello, welcome back to the Wade Borth Podcast. Thank you for joining us today. We're going to go into a conversation around what are the 8 benefits. I've talked about this in previous podcasts and some of our blog stuff on sagewealthstrategy.com. I mentioned it a number of different times. I thought, well, today might be a great opportunity to really start taking a deep dive into what are those 8 benefits, what do they look like. So today, and I want you to kind of just take a step back, and if you haven't heard me talk about why life insurance is such a great value, because it aligns with what you're trying to accomplish, we have to kind of suspend some of the common misbeliefs about life insurance, that it's the most expensive thing you'll ever own. I've heard that said before, and we've talked about it in previous podcasts. But again, value is because we don't understand what expensive is because we don't understand what the value that it brings or what are all the benefits, right? So everybody wants to look at one benefit. They want to look at everything in a vacuum. So if it's a yield conversation or if it's a lot of different things. So today we're going to get into it. And I'm going to share with you kind of some thoughts around why I see this as a tremendous asset in your life and why so many people that think a little bit uncommon are thinking the same thing. When I say people that are a little bit uncommon, I'm talking people with wealth, people that, that run banking operations, the FDIC, people. When I talk people, I'm talking organizations and institutions that see this as a tremendous value, but we've been conditioned to think that it's not a place to put our dollars. And who we've been conditioned to think by? There's a lot of different people. I'm not going to disparage anybody, but I would look at, I heard a gentleman say, I'll put it this way. I heard a gentleman say one time, he said, if whole life was such a terrible investment and you made so much money, then Wall Street would be selling it. But Wall Street's not. And the reason why they're not is because they can't provide all these values in what they offer. They can't provide all the benefits that you get because, again, it's not an investment. And that's the whole thing. And so let's take today and go through a number of these values. We might break this into a 2-part session because there's so much good material here. So again, if you want to have a deeper conversation, if you go, oh, I'm curious because what you said here is making a lot of sense to me, reach out to me, Wade at sagewealthstrategy.com, and let's have a conversation. Give me a call, hop on our website, look at the rest of our content. And I would just encourage you to kind of take this with an open mind and say, how does this align with my value? As I'm listening to this, how is this beneficial to me? And so sit back in your chair, listen, and let's just start going through why I think this is one of the most perfectly placed products or perfectly placed assets in your portfolio. Because again, it serves so many purposes, but it is more akin to a savings and storage of your dollars, and it brings certainty and it brings guarantees to your life. So let's dive into it. So first off, the biggest thing that we're going to talk about are the guarantees that we have within a policy. And so what is that, Wade? What are the guarantees? Well, this is the only product that can guarantee you a death benefit. As long as you, as the owner of this product, fulfill your commitment. I don't know of any other product that can tell you what the exit strategy is out of this policy. It's like having a partnership that you have an exit strategy with 5, 10, 15, 20, 50 years from now. The day you die, it provides cash. It can tell you with certainty what the least amount of liquidity you have 20 years from now. So it is a powerful asset in the sense that it brings a guarantee and a sense of certainty in your financial life that can relieve this idea of financial pressure. So that's going to be one thing, and that's one of the guarantees. It gives us death benefit. Now, we say death benefit, and some people, I hate to talk about death benefit, but let's think about it from what that really is. This idea of a death benefit is really just a liquidity contract. And what does that mean? What does that mean, Wade? Put it in simple terms. It's a contract, it's an agreement between you and an insurance company that says at the time that you graduate from this earth, that somebody will be receiving cash. That's all a liquidity contract is. Now, it's open-ended because we don't know what that time frame looks like. But whenever it happens, that's why it's so beautiful. We don't know when that's going to happen. So when it happens, it's guaranteed that this will pay your beneficiaries some dollars. That's a great benefit. The other part of that is it provides liquidity at the time of death and, quite frankly, every day before that. So think about that for 1 second. It's a liquidity contract that's going to pay at the time of your death. And again, we don't know when that is. That's the open-ended question. And then every day before that. So we can have access to it by either cashing it out or using it as collateral and borrowing against it with no questions asked. And we'll get that in a little bit. But that's a powerful conversation that has that guarantee. I challenge anybody, what other product out there can give you that guarantee with certainty? And again, if you got something, shoot me a message. I'd love to hear it. Comment on, if you're on YouTube, comment in there. Comment in the podcast section, wherever you're at. I'd love to see what those comments are. Next part of the guarantee is that, has cash value increase. And this is actually something that a lot of people don't realize, and they really don't appreciate what that means. The insurance company, again, we deal with mutual insurance companies, and those are just companies ran for your benefit. They're owned by the policyholders. So these insurance companies, these mutual insurance companies, have to increase their cash inside the contract, or their cash value. Let's call it cash values inside the contract, which is just a representation of your cash each and every month. It's going to go up each and every month. And it absolutely has to. It's guaranteed to go up. That's the only way that they can meet that death benefit requirement. That's why whole life is the only asset that guarantees it has to go up. And think about what that means in your life and your portfolio. Think about why banks would want this asset in their portfolio. Each and every month, the cash value has to go up. There's nothing else that they're going to own that's going to guarantee them that part of it. And then the other part of this is, and again, it's really timely in the sense that when we talk about inflation, you're locked into a level premium, guaranteed never to go up. So let me repeat that again. You're locked into a level premium that's guaranteed never to go up. Now, anybody that's owned a house for 10, 15, 20, I've known people that have owned their house for the full 30 years. And when they said they started their mortgage, they thought it was huge, it was burdensome, it was this big monster. And by the time they got done, 30 years later, it was like, yeah, it's just like paying the light bill. It's not that big a deal. Because when you have a mortgage, it kind of works the same way. Your mortgage, unless if you do a 30-year fixed mortgage, so let's not get anything crazy, but a 30-year fixed mortgage, that payment is locked in for the next 30 years. It seems big at the beginning, but by the time that year 30 is over, man, it seems small. Same thing with your premiums on your life insurance, on your whole life insurance policy. Guaranteed never to go up. There's no other, it never goes up, throughout your life. And there's no other product, no other life insurance product, no other product that I'm aware of that can do that and then pay cash at the end. Some people say, oh, my term is locked in for 30 years. Yeah, but what if you die in the 31st year? Then the money's gone. Then the premium had to go up or you dropped it, right? The point is, this is a contract for the rest of your life. It's in the wording, right? Whole life. And it's a liquidity contract guaranteed to pay at the time of your death to somebody. But even if you need cash along the way, you can use it. And there's got to be cash, and it's got to be going up each and every month. So that's the first benefit. Let's move into benefit number 2, constant compounding. So this is an interesting one that people, I think there's a lot of misconception about this. I love this chart. If you think about, if you're on YouTube watching this, fabulous. I would love, put some comments on this. How helpful is this to you in understanding of whole life? So if you can just imagine, close your eyes and just imagine this is what we call a zero line. And from there, when people need money, they either save money and then spend it to buy a car, for example, or they borrow money and then pay it back to the banks. So you can be that person that says, hey, I'm going to save up for a car. And you save up, and then you drain the tank and you buy the car, so go back down to zero. And you save up, go back down to zero. And that happens throughout the rest of your life. Versus the person that says, hey, I'm going to go borrow money from the bank, I'm going to buy a car, and I'll just pay it back over time with a little bit of interest. So you go into debt, you come back, you end up at the zero line. The point is, in all relative terms, you end up basically back at the same spot, no matter what strategy you're using. Now, I always like to ask this question. Which person, the saver or the borrower, does the bank love the most? Let me ask that question one more time because I want to be clear about that. Which one does the bank, appreciate or love the most? Do they love the person that saves money and then takes it out and buys a car? Or do they like a person that borrows money and pays them back? Most people are going to say, yeah, the probably love the borrower the most. When I ask the question in a room, if I'm in a room of 20 or 30 or 40 people, the majority of the people are going to say the borrower. And I'll say, I make the argument that they love them equally. And why do I say that? I know the reason I say that is because think about where money flows. And this is really an interesting concept and a way to think about this. Money flows to the bank. In either scenario, the money flows to the bank. So if the money's flowing to the bank, what do they care? Because they need to have savers putting money in their bank so they can turn around and lend it out to other people. Again, this idea of we should understand, people all the time, I hate the banks. Well, stop hating and be curious about how they make money. Think about how they think about money and emulate that in your life. That's really beneficial. It's a whole other discussion. We can talk about that. But that's really what we should be doing is let's be curious about how banks make money. That's why I'm like, why do banks hold life insurance? We'll talk about that in a bit as well. But the bank doesn't care if you're the saver or the borrower. They always make money. They take and pay you 1% and they charge somebody else 6% for a loan. That's called spread, right? They're not using their money to make that loan. They're using your money. This idea of OPM, they love this because they have your dollars in, and then we can talk fractional reserve banking. They can, probably make that on that same dollar you put in to save. They can probably do 6 or 7 or 8 different loans. But let's not even go there. Even on the one transaction, if you think about it from a retail standpoint, they pay $1 for a hammer. They turn around and they charge $6 for the same hammer. That's a $5 markup, but that's a 500% rate of return if I'm doing my math correctly. And if I'm not, throw that in the comments section. Think about that from the standpoint of rate of return on their expense. So again, we're not talking about the rest of the buildings and all the other stuff, but the point is they have dollars come in and they pay a penny for it, and they're charging 6 or 7 or 8 pennies for somebody to use that dollar. To use that dollar. It's a great marketplace. It's a great business to be in if you understand how the flow of money works. Most people have a tough time with that. And when I say most people, let me back up. People that are not curious have a tough time dealing with that aspect of it because they go, oh, I need to have millions of dollars. Well, no, you start with yourself. Start treating and loving yourself more than you love Wells Fargo. But let's also look at Wells Fargo and what they do. Let's look at what their tactics are and what they're doing, and then you can start applying that. And if you can start doing that, that will take you down to what I call the wealth creator, where, hey, let's start having that money instead of flowing to Wells Fargo, let's have that money flow back into my family system. And then when I have to take a loan, I'll borrow against my own asset to do the same thing, put the same parameters in that Wells Fargo puts in. And we do the same thing and treat our money at least as good as we treat Wells Fargo's money. And quite frankly, if we really understand what's going on, we'll treat it better. So this idea of constant compounding, that's happening within your whole life insurance policy. So from that standpoint, I would just I would challenge you to think about how the flow of money is and which direction do you want that money to flow. You want to flow it out towards Wells Fargo, or would you rather have it flow in towards your system? This is a great one, conversation-wise. The third benefit is liquidity. Liquidity is one of those things that probably is probably not appreciated until it's absolutely needed. So you think about how valuable is liquidity. When we talk liquidity, let's say how valuable is cash on hand. Let's make it really simple and call it for what it is. It is cash that we can get our hands on really fast. So from that standpoint, how does whole life have liquidity? Well, how's that one benefit? So remember what I said earlier, money that's inside your contract has to, by contract and just by actuarial science, has to go up each and every day or each and every month. And so when you start getting equity inside your policy or getting cash inside your policy, then the one thing that's really neat about these policies is that you have guaranteed liquidity. And what I mean by that is you can borrow use your policy as collateral and borrow the life insurance company's money to either take advantage of an opportunity, which what we call acceleration, which what I mean by that is just imagine in a 3-day span that the stock market goes down by 20 or 30%. Most people I hear, I was actually having a conversation with a gentleman this morning. We're talking about, man, that market really went down. We should have been buying stocks. The question is, why didn't most people? Because they didn't have cash. They didn't have liquidity. So they couldn't take advantage of an opportunity. The other side of that equation, what value does liquidity bring? Again, these are the benefits of whole life insurance. It brings a protection asset. What I mean by that is, I had a gentleman on my podcast a while back. His name is Joshua Smith. Go back and listen to that podcast. He had 2 years worth of liquidity inside of his policies. So it wasn't an acceleration conversation. It was a protection conversation, a foundational conversation with him, because he got laid off from GE. He was in a space that GE was not competitive anymore. He got laid off, but he didn't have the financial pressure most people would have by being laid off because he had so much foundational cash or liquidity in hand. And so now he's making decisions out of, hey, what do I want to do in the rest of my life that's going to bring me fulfillment in, the fulfillment in achieving those things I want to achieve, and not making a decision based out of fear. So now he's making more rational decisions versus making decisions out of fear. And that's a protection conversation. So the question is, do you have enough liquidity? How many days of liquidity do you have? And we have a whole series based on this. I would love to take you through our tough money conversation where we talk about liquidity and how important it is, how many, what's your burn rate and how many days or years worth of liquidity you might have or don't have. And the first part of that is awareness. And if you want to change that, then we can have a conversation about how you can look at changing how much money you want to have on hand in order to either take advantage of opportunities or have that protection so you're not having to make decisions out of fear. Next benefit we're going to talk about real quick is the flexible loan provisions. Now, I hear on TikTok, there's a lot of, even on YouTube, there's a lot of conversation about, this flexible loan provision. It's all about the loans. I really think it's an important value, but I don't know that is the most important. But it is a great benefit of whole life insurance. What do I mean by flexible loan provisions? So think about your home equity line of credit. We have a home equity line of credit. Everybody says, I can get cash out of there whenever I want. I might have $50, $80, $100, $200,000, whatever it is, a home equity line of credit. Yeah, you do, until you don't. I would have everybody do a little research of how often Wells Fargo has pulled lines of credit from individuals. It happened in 2008, it happened in 2020. It's happened a number of different times, and it's typically at the most inopportune time. So the guaranteed line of credit is just that extra layer of protection, right? This is one of the benefits of whole life. You have a guaranteed line of credit against the equity inside your policy. That's the first part. So coming back down to the second part, then you have control. You have control as far as when and how that is paid back. Because unlike a home equity line of credit where they set the terms and they typically have a 10-year time frame on that line of credit, you have to requalify, all these things, that's not here. They don't even ask you what you want it for. They just said, yep, you have a line of credit against the equity in your policy. Your money's continue to compound and grow. Just go back to the other benefits. It's guaranteed to go up each month. All those benefits are going on, and at the same time, you have a guaranteed line of credit against whatever equity you have. And when you do take and use it as collateral and take a loan against it, then you can determine how quickly and what rate you want to pay it back. Now, let's also understand that there comes responsibility with that. You want to be respectful of your own dollar. You have to love your money and your family's money and your family more than you love Wells Fargo. So if you're willing to pay them $480 every month at an 8% interest rate, why wouldn't you do the same with your own money? But again, you're the one that can set those terms, or you can suspend it, or you can do whatever you like with it. But you have to treat it with respect. And this gives you the ultimate control of that loaning process. So just think about that for a second. Let's just recap. We have guarantees from the standpoint, we have a guaranteed death benefit, which is called a liquidity contract. Money is guaranteed, it has to go up each and every day or each and every month. Then it moves into this idea of constant compounding. And this is a real benefit because, again, money's flowing towards you versus flowing towards somebody else that maybe doesn't have your best interests at heart. So, and then the liquidity aspect of whole life policies, this is why banks hold money there. It has tremendous liquidity, tremendous flexibility of loan provisions. And it's fairly, can get access to it fairly quick if you need to. And it's got a death benefit to go along with it. It's the instant liquidity, instant cash. So I will leave it there with that. I would love to hear your thoughts. Again, comment. Again, if you're not subscribing to the podcast or the YouTube channel, I'd ask you to do that. It helps us out a ton. And, if you're listening, be sure to check out the videos for the slides, because we're posting this on YouTube as well. There's some great slides here that help bring it into focus. But it just really understand that we're trying to help people get an understanding of what value does owning whole life insurance. So this is part 1 of the series. We're going to break it into 2 parts. So if you're listening, if you're driving, if you're on a short drive, you can get all this. But we're going to take this into part 2, where we talk about the remaining four benefits of whole life insurance and kind of put a bow on the rest of this. So again, thank you for listening. If you want more content around this, sagewealthstrategy.com has got a ton of content, a ton of blog posts. If you want to read about it, listen about it, watch it, we're all about all the different ways to learn. So thank you again for listening, and look forward to seeing you in part 2. If you're enjoying this podcast or know anyone else that might be interested, please be sure to hit the subscribe button and please leave a review. This will help this podcast reach and help more people by ranking higher in searches, and ultimately help more people get out of financial bondage. And don't be afraid to share this podcast with your friends and family, as we can be easily found on Apple Podcasts and Spotify.